Welcome to the Home Inspector Podcast, where we talk about home inspection business, marketing, and making money. I'm Ben Grimico from InterNACHI. That's the International Association of Certified Home Inspectors. And this show is for both veteran, experienced inspectors and for the inexperienced new home inspector. Now, remember, the purpose of being in business, any business, is to make money. If you want to make a good living, don't go into business. Instead, get a good job. The only reason to be in business and to take on all that it entails is to make a really, really great living and to pile up stacks of money for yourself and for your family. And in the Home Inspector Podcast, this episode is like some other episodes of the Home Inspector Podcast. It's geared towards operating a business in the United States. In this episode of the Home Inspector Podcast, it's all about choosing a legal structure for your home inspection business. One of the first decisions that you'll have to make as an inspection business owner is how the company should be structured. And this decision will have long-term implications, so consult with a certified accountant, business advisor, and a licensed attorney to help you select the form of ownership that is right for you. There, that's my disclaimer. Don't take my personal opinion. Hire somebody. The ownership structure depends on how many people will own the business and what type of services it will provide. You've probably thought about this already. If you know that you're going to be the only owner, then a partnership is not what you're looking for. If you're like many inspectors who believe that their services involve a lot of risk, you'll want to not only buy insurance, but also consider forming an entity that provides personal liability protection, which can shield your personal assets. Now, there are benefits and drawbacks of each type of business structure, so consider before making your final decision. The basic types of business structures to consider are sole proprietorships, partnerships, general limited, limited liability companies, LLCs, and corporations. When making a choice, you'll want to take into account the following things: your vision regarding the size and nature of your inspection business, the level of control you wish to have, the level of structure you're willing to deal with, the inspection business's vulnerability to lawsuits, tax implications, expected profits of the business or losses of the business, whether or not you need to reinvest earnings into the business, and your need to take cash out of the business for yourself. Let's go to sole proprietorships. Now, the vast majority of inspection businesses start out as sole proprietorships. These firms are owned by one person, usually the home inspector, who has day-to-day responsibility for running the business. Sole proprietors own all the assets of the business and the profits generated by it. They also assume complete responsibility for its liabilities and debts. In the eyes of the law and the public, the inspector is one and the same as the business. A sole proprietorship is not legally separate from the person who owns it. Some advantages of a sole proprietorship. Well, it is the easiest and least expensive form of ownership to organize. Sole proprietors are in complete control. Sole proprietors receive all income generated by the business to keep or put back in. Profits from the business flow through directly to the owner's personal tax return. The business is easy to dissolve. Now, disadvantages of a sole proprietorship. Sole proprietors have unlimited liability and are legally responsible for all debts against the business. Their business and personal assets are at risk. Owners may be at a disadvantage in raising funds and are often limited to using funds from personal savings or loans. Owners may have a hard time attracting high-caliber employees or additional inspectors, or those who are motivated by an opportunity to own part of the business. Some traditional employee benefits, such as owner's medical insurance premiums, may not be directly deductible from business income. At income tax time, a sole proprietor reports all business income or losses on the individual's income tax return. The business is not taxed. The business profits pass through the business to be taxed on the business owner's tax return, and this is referred to as pass-through taxation. Once your inspection business is creating a profit, you'll have to start paying taxes. Hire a professional advisor to help you with deductions and record keeping, to help you reduce your tax bill and to stay out of trouble with the IRS. Partnerships. In a partnership, 2 or more people share ownership of a single business. Like proprietorships, the law does not distinguish between the business and its owners. The partners should have a buy-sell agreement that sets forth how decisions will be made, how profits will be shared, how disputes will be resolved, how future inspectors will be admitted to the partnership, and how partners can be bought out, and what steps will be taken to dissolve the partnership if needed. While it's hard to think about a breakup when the business is just getting started, many partnerships split up at times of crisis, and unless there's a defined process, there will be even greater problems. Partners must also decide upfront how much time and capital each will contribute. Advantages of a partnership. Partnerships are relatively easy to establish. With more than one owner, the ability to raise funds may be increased. Profits from the business flow directly through to the partner's personal tax returns. Prospective inspectors may be attracted to the business if offered an incentive to become a partner. And the business usually will benefit from partners who have complementary skills, especially when inspecting as a team. There are disadvantages of a partnership. Partners are jointly and individually liable for the actions of the other partners. Profits must be shared with others. Since decisions are shared, disagreements can occur. And some employee benefits are not deductible from business income on tax returns. And the partnership may have a limited life. It may end on the withdrawal or death of a partner. There are types of partnerships that could be considered. The general partnership. Partners divide responsibility for management and liability, as well as the shares of profits and loss according to the agreement they have. Equal shares are assumed unless there's a written agreement that states differently. Limited partnership and partnership with a limited liability. Well, the limited means that most of the partners have a limited liability to the extent of their investment, as well as limited input regarding management decisions. This form of ownership is not often used for operating retail or service businesses. Joint venture. Joint venture is similar to a general partnership, but it's clearly for a limited period of time or maybe a major single project. Corporations. A corporation, chartered by the state in which it's headquartered, is considered by the law to be a unique entity, separate and apart from those who own it. A corporation can be taxed. It can be sued. A corporation can enter into contractual agreements. The owners of a corporation are its shareholders, and the shareholders elect a board of directors to oversee the major policies decisions. The corporation has a life of its own and does not dissolve when ownership changes. The advantages of a corporation. Shareholders have limited liability of the corporation's debts and judgments against the corporation. Generally, shareholders can only be held accountable for their investment in stock of the company. Corporations can raise additional funds through the sale of stock. A corporation may deduct the cost of benefits it provides to officers and employees. And it's easier for shareholders to sell their inspection business when they want to retire. Disadvantages of a corporation. The process of incorporation requires more time and money than other forms. Corporations are monitored by federal, state, and some local agencies and may have more paperwork. Incorporating may result in higher overall taxes. Subchapter S corporations. The S corporation could be attractive to small business owners than a standard corporation. That's because an S corporation has some appealing tax benefits, and it also provides business owners with liability protection of a corporation. Income and losses are passed through to shareholders. The catch here is that the shareholder, if working for a company and if there's a profit, must pay themselves wages, and it must meet standards of reasonable compensation. LLC, Limited Liability Company. The limited liability company is a relatively new type of hybrid business structure that is now permissible in most states. It's designed to provide the limited liability features of a corporation and the tax efficiencies and operational flexibility of a partnership. Formation is more complex and formal than that of a general partnership. The owners are members, and the duration of the LLC is usually determined when the organization papers are filed. LLCs are taxed as partnerships in most cases. In summary, deciding the form of ownership that best suits your inspection business should be given careful consideration. Use your key business advisors, trusted mentors, licensed attorneys, and certified accountants to assist you in this process. Here's your checklist. Identify the number of owners of the business. Then analyze your business risks and exposure to personal liability. Figure out how you'd like your business to be taxed. Then choose a business structure. Visit the following URL to access InterNACHI's Inspector Library of Documents. It's at nachi.org/documents. My name is Ben Gromyko. I'm from InterNACHI. That's the International Association of Certified Home Inspectors. You've been listening to the Home Inspector Podcast, and we just talked about choosing a legal structure. In the next episode, we're going to talk about choosing a business name. That should be a lot of fun. See you next time.